In the world of investing, some of the most tempting opportunities, the ones that promise these incredible returns for what seems like very little effort, well, they often hide the biggest dangers. It's a classic horror story, really. The hero goes chasing after a glittering prize, only to walk right into a trap. And that's where this quote from Eleanor Roosevelt really hits home. It's pretty much the guiding principle for our whole discussion today. The idea is to learn from these costly mistakes so we can gain the wisdom without having to feel the pain ourselves. All right, let's kick things off with our first section, the siren song of yield. This is all about why those super high returns can be such a dangerous lure. Our story really begins with this concept that every income investor knows all too well. It's this beautiful melody that promises safety and financial freedom, but it can pull even the most careful investor onto the rocks. So, what are we talking about here? At its core, this behavior is called yield chasing, and the mistake is actually pretty simple. It's when you get completely fixated on one number, that big, juicy yield, while totally ignoring all the other critical stuff, like the risks involved, the actual health of the company, and what's going on in the broader market. This brings up a really important question, though. If the trap is so obvious, why is this behavior so common? Why do so many of us fall for it, especially when the economy is acting a certain way? Well, the data is pretty clear on this. Research from the Federal Reserve shows a very distinct pattern. As those safe, risk-free interest rates go down, investors start moving their money into riskier and riskier assets. This isn't just a guess, it's a documented, measurable shift in behavior. In a low interest rate world, the pressure to find a decent return basically forces people to take on more risk than they otherwise would. And that external pressure from the market really sets the stage for our own internal fatal flaws. It's our own psychology, these cognitive biases that are just hardwired into how we think, that really makes us vulnerable to that siren song of a high yield. So the first fatal flaw we've got to talk about is overconfidence. This is that little voice in your head that says, I've got this, I can outsmart the market. It makes us overestimate our own ability to pick the winners, and maybe even more dangerously, it makes us underestimate the risks we're taking on. And check out this disconnect. A study showed that 64% of investors believe they have a high level of investment knowledge. But then you look at the pros, the professional fund managers, and over the last decade, only about a quarter of them actually managed to beat the market. I mean, if the experts are struggling that much, what does that say about our own confidence? That gap between how good we think we are and how we actually perform is exactly where overconfidence lives. Okay, next up we have this incredibly powerful force called herd mentality, and it's supercharged by its modern-day partner in crime, FOMO, or the fear of missing out. This is that impulse to jump on a bandwagon just because everyone else is, instead of doing your own homework and analysis. And the power of the herd is honestly kind of terrifying. Studies have shown that it only takes a tiny group, just 5% of informed investors, to start a domino effect that influences the other 95%. Think about that. It's not just a little influence, it's a full-blown stampede, and it's exactly how speculative bubbles get their momentum, pulling almost everyone right along with them toward a cliff. And our third psychological flaw is something called loss aversion. This is a huge concept in behavioral economics, and it basically proves that the emotional pain we feel from a loss is way, way more powerful than the pleasure we get from an equal-sized gain. This imbalance in our emotions is what drives so many bad decisions. Making $1,000 feels good, but losing $1,000, that feels absolutely awful. And it's that fear of feeling that pain that leads to irrational behavior, like holding onto a losing high-yield stock for way too long, just because selling it would mean you have to admit the loss is real. Okay, so let's move away from the theory and look at some real-world consequences. These aren't just abstract ideas. So now we're going to dig into a few cautionary tales, some short, true horror stories from the investing crypt. Just listen to this personal story from an investor. He was drawn in by this incredible 17% yield and thought he'd hit the jackpot. His focus on that one number completely blinded him to all the underlying risks. And the result? The stock crashed 40% in just 1 year. Ouch. The lesson here is crystal clear. A super high yield is not a free lunch. It is a massive, flashing red warning sign. It's the market's way of telling you that there's a really high chance something bad is about to happen, like a dividend cut or the stock price just collapsing. This is exactly why doing your due diligence is never, ever optional. Now, our next story shows a totally different kind of mistake, one that was born out of pure panic. Back in the chaos of March 2020, an investor sold their entire bond portfolio, the part that's supposed to be safe. Then, just 3 months later, after the market had already started to recover, they bought back in, paying more for the same exact assets they just sold. They literally locked in their losses because they were scared. And this just highlights one of the most fundamental truths of investing. You can't control what the markets will do. You just can't. But you can always control how you respond. Panic, which is fueled by loss aversion and that herd mentality, is without a doubt the worst enemy your portfolio will ever have. So these individual flaws, when you multiply them by millions of other investors all feeling the same thing, they don't just stay as small, isolated mistakes. They all add up, they escalate, and they create these massive, market-wide events where collective greed literally becomes a monster, inflating these huge speculative bubbles. And we can actually measure this collective emotion using tools like the Fear and Greed Index. It takes a bunch of different market indicators and boils them down into a single number, from extreme fear all the way up to extreme greed. It's basically a thermometer for the market's move. And this index isn't just pulling a number out of thin air. It's built on 7 key market indicators. It's looking at stuff like stock price momentum, how investors are using options, market volatility, and even the demand for risky junk bonds. It puts all that together to give a really solid picture of whether fear or greed is driving the entire market. If you want to see a perfect historical example of this, just look at the dot-com bubble. In the late 90s, the Fear and Greed Index was stuck on extreme greed, often reading above 90. All that euphoria pushed the Nasdaq to its peak in March 2000. And when that bubble finally burst, the result was a nearly 78% crash, wiping out $5 trillion in value. The monster of greed had had its feast. Okay, so we've walked through the whole anatomy of this horror story, and now we get to the most important section of all, your survival guide. This is where we turn these scary stories into a practical, actionable plan to help you overcome your own inner monsters of fear and greed. Your survival guide really just comes down to a 3-step plan. First, seek clarity of thought. You have to ask yourself, am I buying this because it fits my strategy, or am I just following the crowd? Second, understand what you're buying. Look past that high yield number and actually investigate the business fundamentals. And finally, number 3, develop a disciplined plan. A long-term strategy that's based on your goals and your risk tolerance is your best defense against all the market noise and emotion. So, I'll leave you with this one final question to think about. Are your investment decisions being driven by a sound, logical strategy, or are you just getting pulled around by the market's emotional tides? Answering that question honestly is the first real step to becoming a more disciplined and ultimately a more successful investor. If you found this explainer helpful, please click like and subscribe to FinBot Insights for more deep dives like this one.